Welcome to December. It's a new month with New Year on the horizon, maybe already a bit of a new attitude.
So, three-quarters of Americans said they fell at least somewhat short of hitting their money resolutions. 84% are confident in being able to achieve their financial goals for next year.
That's Sonia Freyer, head of cash management at Vanguard. And she's talking about how coming off of a year in which Americans fell short of their saving and spending resolutions, most believe they're going to make it next year. But that's not even the only survey we're talking about today, because we've also got Rob Williams, managing director of financial planning at Charles Schwab, discussing their latest modern wealth survey, which showed that 2/3 of Americans believe they've got to look beyond stocks and bonds to diversify and succeed in today's market. Plus, David Trainer, founder and president at New Constructs, takes us to the danger zone. But in honor of the holidays, it's for a stock that he's really thankful he put there because it's been so good as a short. Plus, Jake Cousineau, author of Face Your Financial Fears, the simple guide to fixing your relationship with money.
My little party's just beginning.
Welcome to the party, pal. This is Money Life for December the 1st. Thank you so much for joining me. My name is Chuck Jaffe, and we have a great show planned and executed for you today, coming off of the holiday weekend. And I hope you had a great weekend. Yes, we were here on Friday, but we did a lot of that stuff in advance. So this show also done largely in advance so that we could have some time off on the holiday. And I had a really nice holiday weekend. Yes, if you know, I'm a Michigan grad, and Michigan lost the game to Ohio State on the football field this weekend. Disappointing, but it's going to happen. You can't be in a great rivalry and expect to be able to win all the time. If you win all the time, it certainly would not be a great rivalry. But I'll also just point out it's a great time for Michigan sports because we've got the number one hockey team and we have a basketball team, men's and women's, actually both in the top 5 nationally. So I've been loving all the Michigan sports scene. And yeah, you're going to have a little rainfall in your life every now and again if you're a sports fan, no matter how well everybody's doing. So that kind of weekend. But the rest of the weekend, well, my little party's just beginning. That, of course, from the original Wizard of Oz, Gail and I went to see with her daughters, went to see Wicked 2 on Thanksgiving. The day after Thanksgiving, Black Friday, I was kind of laid up. My back was really bothering me. Thankfully, a day of stretching and taking care of it and taking it easy made it that the rest of the weekend, everything was fine. I feel better. Sunday night, Gail and I went off to a concert. We saw Gavin DeGraw, who was playing a mix of holiday music and then some of his classics. We're actually going to another holiday concert this week, which we're excited for. And then we've got a little bit of travel because we're going to see Declan. Yep, we're going to see my grandson. Can't wait to do that as well. And then we'll be back home for the rest of the holidays. So it's going to be a busy month. And it's a hugely busy month here on Money Life because we have an incredible lineup because it's now Outlook season and the Outlook is really interesting. But before we get to the Outlook, I just want to point out really interesting piece up from Larry McMillan. Larry McMillan, friend of this show, is one of the guests who's been on many, many times. Lawrence McMillan runs McMillan Analysis. He is a guy who writes a column for MarketWatch. And he basically was pointing out that, you've got the next 6 weeks. The market has 3 classic patterns and things that it looks at, right? So the market tends to rally after Thanksgiving for a week or two, right? Even the worst December market ever, which was 2018, the post-Thanksgiving trade, the 2 weeks after Thanksgiving was profitable. And he's pointing this out in a MarketWatch column. Then, of course, you get to the Santa Claus rally pattern, which starts the last week of December and ends on the second trading day of the new year. So again, it's the post 2 weeks, then there's a breather, then you get the Santa Claus rally. That's traditionally what happens. We'll be watching to see if it happens this time. But into all of that, that's short term. We've got all these long-term outlooks coming from fabulous money managers. So, a lot of the big names are coming. They're putting out their forecasts, and their forecasts for this year were wrong from the standpoint of how they expected the year to turn out day to day, but they were right from a long-term perspective. Last year what we were getting from people when the outlook was it's going to be a benign year. It's going to be the kind of year where we'll see what happens, but we should wind up with a, modest single digits kind of gain. I think that's the default. I think that when somebody doesn't quite know what to say, that's what they say. And then they wind up being not too wrong under any circumstances. And that's what we're looking at. So I would say a lot of folks were wrong because we got a market that reached where they wanted it to reach, but not the way they wanted it to reach there, and not because of the things they were expecting. But you can be your own judge on all this stuff, and that's what we want you to do. We hope you'll tune in every day and let us know what you think. Chuck@moneylifeshow.com is how you reach me. But right now, we're going to get into the here and now on today's show. Again, our lineup: Sonia Frayer, David Trainer, Rob Williams, Jake Cousineau. The first of two surveys kicks things off when we're really rolling. Next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
It's time to take a look at what the survey said. Welcome to The Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data, frankly, that's going to help us understand what people are doing for, with, and about their money. And as we head towards the end of the year, well, we're going to be looking at financial resolutions. There's a couple of different studies, but it's the first one we're going to take a look at this year. And I love it because it suggests that Americans are expecting something of a financial resolution rebound in 2026. This survey out from Vanguard. It's Vanguard.com if you're looking for more information. But if you want to get directly to this survey and you want to maybe see, okay, where do people start to fall out on the numbers, and maybe where would I fit in? Or as I start to make my financial resolutions, what might I be thinking about? Well, look for Sonia Frayer. She's my guest. She's also head of cash management for Vanguard. Find where we mention her in our show notes today. You'll find the direct link. It's also on our guest page if you go looking for her there. Sonia Frayer, welcome to Money Life.
Thank you so much, Chuck. Happy to be here.
Let's start with the idea, and this is the thing that fascinates me, that we kind of need a financial resolution rebound in 2026, because that suggests that 2025 people did not keep their resolutions. And that's to some extent what you found, wasn't it?
It was, and I love the way you phrase that. So, a financial resolution rebound. I think we can all be honest that 2025 threw some headwinds our way. But that's really the great thing about turning over a new leaf when it comes to starting a new year. It's the perfect time to take stock of maybe where we fell short and develop a plan to put the wind at our backs. And our recent survey was exciting to reinforce that idea.
So I have a very interesting relationship when it comes to resolutions, because I've done sort of every system you could have. I've written about it many times over the years. And frankly, I've given up on resolutions themselves. And I gave up on resolutions for a reason. And it actually plays into the research, which is a resolution. Most people's resolve is gone the minute that they break the resolution. If you say, I want to lose weight, and you go off and eat 2 pieces of cake and you're not dieting, it's harder to get back on and keep going. If, on the other hand, you set a goal and you say, I'm hoping that when I get to next year and I'm going to re-up my goals, my weight will be down or my financial savings will be higher, et cetera. Well, you can have missteps and still reach your goal. So I'm more about goal setting than I am about resolutions. But this is what makes me wonder. When you're looking at this and the folks say, yeah, we didn't hit our resolutions, did that still mean that, at least financially speaking, they've been looking at 2025 going, not a very good year? Like, I didn't reach my resolutions. That's a sign of a bad year, no matter what the market says.
So, our survey found that even though 75%, so 3/4 of Americans said they fell at least somewhat short of hitting their money resolutions, 84% are confident in being able to achieve their financial goals for next year. So we're viewing this as incredibly positive. Really, what this signals is that to your point, people are developing plans that even if they maybe didn't get all the way there, they're building on the successes of last year and they're outlining the steps that it's going to take to reach those goals starting next year. And so thinking about, the market volatility, the macroeconomic climate, there are a couple really important tips that we know lead to greater success when it comes to hitting those money goals. I'll maybe go through a couple of them. First and foremost, so obviously, in order to hit those shorter term or emergency savings goals, which were two of the most important goals that were surfaced in our survey, number one, we think it's critical that people review where their money is being kept. Because as we know, the interest that you're earning on your money is one of the best ways that you can make progress. So, putting a set it and forget it mentality, but doing that after you've made sure that you're earning the returns that you deserve on your savings product is really one of the best ways that you can set yourself up for success.
As people were looking ahead, was there any thought about changing the resolutions they had for this year? Was there a thought that 2026, I will change the resolves I had because 2025 was less than successful?
It's a great question. So, I would say we see a lot of consistency in savings goals year over year. For us, I mentioned the two that surfaced most clearly. Number one, building up that emergency savings buffer. And I don't think that comes as a surprise given, some of the backdrop and what we're all feeling. Number 2 is people are really interested in making progress against their goals and what matters most and using high yield savings products to do that. I think we can all identify with that. We're all saving for, whether it's travel, a big trip, whether it's saving for a down payment, whether we want to buy a car. These are some of those shorter term goals that are just such an important part of not just our financial lives, but our lives overall. And those are the things that people consistently cite as most important to them.
How much do current events impact the way people are setting their resolutions? Not just in their ability to achieve them, but in terms of if you're looking out and you see market conditions or economic conditions that are uncomfortable, you would think you would make your goals more modest. So are people making, are we going to see a rebound in resolutions, not just because people want to make them, but also because, hey, they're going to be easier to make this year because I've just made them easier to achieve?
I would point back to why saving consistently over time, regardless of the rate environment, regardless of what's going on with the economy, sets people up for success long term. And what I mean by that is this idea of really making savings a part of your behind the scenes autopilot plan. And so, the same way that some of my bills are on autopilot, I have some orders and refills that come in automatically. I don't even need to think about it. For example, on Amazon, you know, I encourage people to save automatically. Either it's you're setting a portion of your paycheck aside without thinking about it, you're doing a reoccurring transfer. And this is where it's really important to have that be an amount that you almost don't even notice. So even for people that want to start at $10, $20 every time they get paid, this adds up over time. And it is more important that it becomes a part of just the foundation and that you aren't feeling the pain. Because I think when people think, oh, maybe I was overly aggressive in terms of that goal, I stretched myself a little bit too far, I'm just going to stop it for a little bit. It's the consistency over time coupled with making sure that your money is earning a great rate. And you can use, by the way, APY as a great apples to apples comparison on what you're earning on your savings products. I'll throw in here a great reminder for people to check how much they're making. Traditional bank savings accounts can earn pennies on the dollar. The average amount that people are saving is less than 0.5%, believe it or not. There are products out there that are earning far more. Vanguard's Cash Plus account is earning 3.5%. That's 8 times the national average. So I like to say it's kind of the two-part effect of make sure your money is earning a great APY and that that's the product for you, and then kind of put everything on autopilot and don't think about it. I guarantee that you will be surprised when you come back to see how much the effect of compounding and interest over time has grown your savings goals. So I think those things, when I think about it as anchoring back, 84% of Americans have a financial resolution going into next year. That's fantastic. These are some of those tactics that can help ensure that more and more of them reach those goals. And we already know that they're confident they're going to do it. I wouldn't be surprised if many of them are using some of these steps already.
Well, it would be great to finish the year on a high note, at least where people are bringing optimism into the new year. Glad to see that they've got it. We will be undoubtedly exploring this with others. But meanwhile, the first of the resolution stories that we're going to have for this year is a really strongly positive one from Vanguard. Sonia, thanks so much for joining me to talk about it.
Thank you so much.
That's Sonia Freyer. She's the head of cash management at Vanguard. You can go to Vanguard.com to learn more about the firm and everything they do and to find out about that Cash Plus account she was talking about. But you can find the direct link in our show notes and on our guest page if you want to go take a look at their financial resolution study and try to see where you fit in and maybe start shaping your resolutions for 2026. One thing we know you're going to resolve to do in 2026 is stick with Money Life all the way through. So why don't you get a jump on that? We'll be right back with more. Don't you go anywhere.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
If you're looking for trouble, you're in the right place. But it's not quite the baddest biker bar in the investment world. It might be the most thankful family scuffle in Thanksgiving history. This is the Danger Zone. Yes, welcome to the Danger Zone on Money Life. It's where we get the latest take from the experts at New Constructs, where they bring together discounted cash flow analysis and forensic accounting to examine stocks and funds and ETFs in a way that most don't. They dig in at the footnotes level, work their way up, and they're looking for places where the numbers can be misleading. And if they're misleading and they work in your favor, well, that would make something attractive. But we normally focus on the things that are dangerous. But this week, well, it's right after the Thanksgiving holiday. And so, although there are things that are dangerous, David Traynor, founder and president at New Constructs, he's got reasons to be thankful for some of them because, hey, they've paid off. So, yeah, we're talking dangerous stocks, but not necessarily the way we always do. We're talking about the ones he is thankful for. If you want to learn more about the ones that have worked out, also the ones that haven't, they're not shy about it. Newconstructs.com is where you go for more information. David Traynor, welcome back to Money Life.
It is good to be back, Chuck. Thank you.
So, which Danger Zone pick are we particularly thankful for this year?
Sweet Green.
Sweet Green. It is ticker symbol SG. It has been in the Danger Zone before. And yeah, the stock has sucked more than a salad that doesn't even have any salad dressing. But that's kind of what Sweet Green sells, so maybe it shouldn't be a surprise. As you've said since the very beginning on Sweet Green, it's an overpriced stock when all they're really doing is giving you some lettuce.
Yeah, Chuck, and it's also, a crowded space. There are a lot of other firms that have been doing this. I mean, I remember 25 years ago, every deli in New York City had basically a Sweet Green setup. You pick either spinach or romaine, and they would put all this stuff in there and mix you a fresh salad. And it was inexpensive. And so, yeah, it's an expensive salad situation where there are cheaper salads that are just as good.
But it's also a situation where at any price, pretty much, this stock tastes bitter. What you've said from the very beginning is not just bad business model. You've said ridiculously overpriced. And the reason you're thankful for it is this stock has had the tar beaten out of it, but I think it's still, in your book, ridiculously overpriced, right?
Yeah, no, it's still really expensive, Chuck. It's effectively priced as if it's going to be the next Kava or better. So it's got to improve its margins to Kava levels while also growing revenue at 11% compounded annually for 15 years. So, that seems 11% in the restaurant business compounded annually over a long period of time. That's big. and then while also getting margins up to Kava levels, that's what's priced into $7 a share, man. So like you got a lot of improvement and growth baked into the stock price.
Well, I'm laughing because the comparison here is Kava, which has also been in the danger zone, which you've also identified as a bad stock. I've read the report. You could have looked at competitors and gone with like Red Robin, which has been in trouble for a long time. And Sweet Green has, less return on invested capital than that too. But you picked Kava. So if they have to go that much to be as good as Kava, you're literally still going, that keeps you at the bottom of the barrel, doesn't it?
It does. Kava is a very expensive stock, right? But the business model has improved. Like it's one where the business model for Kava is actually seems to be getting to a place where it's not a complete like joke business. It has profits. It has a decent return on capital. It's still terribly expensive, but the business model is working. It's still overpriced in a way that Sweetgreen's business model is not working, in a way that Red Robin's business model has not worked, in a way that Shake Shack's business model has not worked, in a way that Cracker Barrel's business model is not working, in a way that Cheesecake Factory is not really working. So like Kava's, at least landed in some somewhat marginal profitable territory. Sweetgreen is still way behind.
I want to point out that as I was getting ready for Thanksgiving, I went to a mall here to pick up one thing I needed to work on the Thanksgiving food I was making. And in that mall, there is a Sweetgreen, there is a Kava, there is a Shake Shack. It is like the danger zone's greatest hits of bad restaurants. But now I know that I need to eat at Sweetgreen and Shake Shack first because they're likely to be out of business sooner than Kava if we're looking at this. In the case of Sweetgreen, given where they're at, are they a zombie stock, and how overpriced is $7 a share?
$7 a share is overpriced by a lot. So yeah, I told you to justify $7 a share, they've got to do that 11% compounded annual growth for 15 years and getting up to Kava level margins or return on capital of margins that are highly profitable, or a return on invested capital up to 23%, that's a big number. You look at those comps, there's not many firms that get up to 23. That puts them in Yum Brands and Roadhouse territory. So that's really expensive. The economic book value, the no growth value for Sweetgreen is negative $10 a share.
We said you are particularly thankful for Sweetgreen because it's been a danger zone pick that has paid off. What we haven't talked to this point is just how good it's been as a short. So give us those details as best you can, please.
Yeah, Chuck, Sweetgreen has really done well in terms of outperforming as a short. So it's down 80% while the S&P is up about 15. So that's 94% of outperformance. And so I think that's a pretty strong danger zone pick. We think it could still go lower. It is still on the zombie stock list.
I know that we put it in the danger zone basically when it came out, and it became a zombie stock in March of 2023. And at the time, the stock was trading somewhere in the $15 per share range. And of course, it's now trading under $7. So yeah, we certainly have seen it take a pretty significant haircut. The flip side of that is you predicted bad things for this from the outset. Like this was IPO, bad deal, don't do this, etc. And yet it's still here. Sweetgreen has managed to survive. There's not stupid money risk because you don't see somebody coming in and buying it because the setup's bad enough that why wouldn't they just do it themselves or what have you? But is there a catalyst that typically puts a company like this on the outs? Like, obviously something like a pandemic could do it, but that's not something you can forecast. Is when you see the bad food companies, is there something typically that is the catalyst?
It's really tough, Chuck, to be completely honest with you. We are dealing in a world where a lot of business would have gone bankrupt. But what some of these financiers like to do is swoop in with some debt and convertible debt, get shares at pennies on the dollar, save the business, see the stock go up because it has been saved and given debt, and then cash out on the stock. And they do this over and over. Carvana is a classic example where this has been going on. So typically, a lot of these bad businesses we talk about, they go out of business because they run out of cash. They can't get anybody to give them more because no one's going to borrow, lend money to a company that's losing money. That's used to be how it works. These days, the way stuff's going down, I can't tell you. It's hard to say because there are people out there that know that they can take advantage of these situations to make a quick buck.
Does a company like Sweetgreen, in your opinion, benefit or hurt from things like the tariffs and inflation? Because on the one hand, yes, you can say, as you have, it's an overpriced salad. On the other hand, when people are not necessarily wanting to go out and spend a lot of money out on meals, it is cheaper than going out to, a fancy restaurant. So are they benefiting or are they hurting because of what's been going on?
I think they're more hurting than they're benefiting because salad is not necessarily considered a nice meal. It's a fancy salad. Like it's the fanciest salad place. It's going to be my impression when I've walked around some of these places. That's not real popular. I think that's part of why they're struggling. I mean, we're still seeing negative margins, big time free cash flow burn, and we're seeing negative return on capital. This business is not working in any way. And I don't, whatever the environment is, and I don't think it will.
And that's why Sweetgreen, SG, well, again, thankful for it if you're David Trainer, not so thankful if you are an investor back in the danger zone. David, great stuff. We'll talk to you again next week.
It is great to be with you, Chuck. Thank you.
David Trainer is founder and president at New Constructs. Go to newconstructs.com for more information on the firm, to check out the most attractive and most dangerous stocks and more. And we'll be back with more of today's edition of Money Life right after this message.
Oh, wow. This is actually pretty dangerous.
To navigate today's complex market, investors need accessible, quality research. VettaFi offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
Now Money Life looks at what the survey said. Welcome to The Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data. It's going to help us understand what people are doing for, with, and about their money. And today we are looking at the latest release of data from Charles Schwab's 2025 Modern Wealth Survey. This is a survey that we've dug into a number of times in the past because, well, it takes a look at a lot of different parts of how people are handling their money. And today we're looking at what's going on when it comes to investment allocations. And you hear us talk a lot about alternative investments and things like that on this show. And some of you occasionally go, come on, who's actually buying that? Well, the answer is a lot of people, because about 2/3 of Americans believe that these days they got to look beyond stocks and bonds. Here to discuss it, Rob Williams. He's managing director of financial planning at Charles Schwab. It's schwab.com. Find where we talk about Rob on our guest page or in our show notes. You will find the direct link to the Modern Wealth Survey for 2025. Rob Williams, it's great to have you back on Money Life.
It's great to be here, Chuck. As always, thank you.
2/3 of Americans now think they have to look beyond traditional investment products. So that's alternatives really are stocks, bonds, cash, and maybe real estate as investments. They're looking beyond that. And another 40+% or 40+% of your respondents said that 60/40 as a portfolio is outdated. Is this because they're learning? Is this because they have fear of missing out? What's driving the look for other assets?
I think it's a little bit of both. And I'd add a third is just innovation. We've spent 50 years democratizing and getting access to the stock market, bond market, et cetera. That's great. But the investing landscape just continues to evolve and change, even from what was 5, 10 years ago or 2 years ago. So this pace of innovation, the different opportunities, what we see out there in the market, cryptocurrencies, private equity, certainly you mentioned real estate, owning a home, et cetera. That's the pace of change. There's also some fear of missing out. When we see a lot of news on cryptocurrency, et cetera, certainly more and more people are telling us that they're interested in it and that they may own it. They also tell us that they understand generally after, their immediate exposure that it does come with some risks. And so that's encouraging. And the third point you made, education. yes, you get exposed to something, you buy crypto. It's really encouraging in the survey that we see that investors may be exposed to that, buy crypto, but then they're really looking for help. That they want to get educated on it. They realize they need patience. So all three of those are involved in this change.
But the more educated investors become, do they become more patient? Like, I understand what it takes to be a value investor, so I go for the long haul and I'm willing to ride it out. Or do they become less patient because I know so much, I should be able to make more money than this, so I'm out?
It's really interesting to see. It's a bit of a paradox. You look at our survey, and more than half say that investing requires more short-term risk than in the past. So I think they see that the market goes up and down. Cryptocurrencies, as an example, they're not limited to that, can be quite volatile. But then after their first exposure to it, they also tell us that being patient and having a long-term strategy is also important. So that seems like a paradox. It's like, which is it? Well, it's a bit of both. And that's pretty normal and natural. We see the news, we're getting more and more of it. It's hard not to pay attention to the ups and downs of what's going on in politics, the markets, et cetera. And so it seems like there's a lot of short-term risk, but patience is required too. Now, this does not mean, and people don't tell us that just means set it and forget it. More and more people are looking at their portfolios more regularly. They may be trading or rebalancing. So the old set it and forget it doesn't seem to be, as popular. But knowing that you need patience, it's good to see that that's certainly a trend as well.
One of the numbers in here absolutely fascinated me. And I'll read the portion of the study or the write-up on the study where I was like, wow. And it says, on average, stocks make up a quarter, 25% of investors' portfolios, followed by mutual funds at 13%, bonds 8%, and cryptocurrencies at 10%. I'm a math guy, and I know that that's only 56%, 25 for stocks, 13 for funds, which, by the way, could be stocks or bonds. That's not actually specific there. 8% for bonds and 10% for crypto. Well, I would find that a portfolio that has too much crypto, like, yeah, and then not enough. And what's happening with the rest of the money?
Yeah, if you look at the statistics, so looking at this, and stocks are 64%, mutual funds 41%. And sometimes people are like, that's an interesting point in of itself. Do you think of stocks as individual stocks, or mutual funds as a way to invest? And so there may be, people are answering these questions, and this points to the education. How did you answer the question? We're not looking at their portfolio and saying this is actually how they're investing. But the 10% maybe jumps out to you, as well as cryptocurrency. This is a selection of investors. Many are sort of getting started in investing, and they may have cryptocurrency as something they're speculating in or investing as part of their portfolio. Another really interesting part of this is people tell us they have multiple portfolios. They may have a retirement plan, and then they're investing in their, for their short-term trading. So yeah, as with any survey, it's interesting to see how people respond. The math doesn't always add up.
Well, and I should point out, when you brought up that it's over 60% with stocks, that's how many investors have stocks. The number I was looking at is how much do stocks make up of an investor's portfolio?
Yes, good. Yeah, good point. So different numbers, very interesting way to look at them. Yeah, so good point.
Well, does it also mean that investors, for whatever they're taking, like, I can look at the crypto and go, well, 10% in crypto sounds high to me, but only 25% in stocks. Even if you said, oh, the 13% is all mutual funds, 38% in stock mutual funds would still seem like, wait, you have too conservative a portfolio for almost any age.
Yes. Yeah. No, I mean, I think that's interesting. And again, we look at these surveys and we're trying to get a sense of sentiment. This is not looking at their actual portfolios and how they are actually invested. So I think it points out that people are thinking more about cryptocurrency, et cetera. Maybe they're not looking at the allocation of their 401k portfolio, et cetera. To me, it sort of highlights that there's a lot of attention to crypto, et cetera. The other stats that you mentioned are also encouraging. I mean, 65% still own stocks, still own some of those more traditional investments. So, like anything in these surveys, it's interesting to kind of parse how people respond, and then look at how they're actually behaving may sometimes be different.
Is there anything that you take out of this in terms of what you would expect to see from investor behavior? I'm asking you to look at the survey numbers and now go beyond them because you are the director of financial planning. And so when you see investors saying, okay, I'm willing to extend, I'm willing to do more, maybe I need more education to do it. Do you believe that, the next time the market kind of gives us enough of a shock to panic people, that folks will go, wait, I got a lot of cash on the sidelines, I will buy in, which would be an action that if it happens en masse, helps to stop and curtail a market decline? Or do you think, what this shows us is that investors are still too conservative, which means the next time there's a shock, they're still going to be panicked?
Well, I don't think the survey sort of indicates to us that the investors surveyed here are being too conservative. What it tells me is they're looking for alternatives and places to invest their money that go beyond things that they find more traditional, and they're looking for innovation. And we mentioned cryptocurrencies, but alternative investments like private equity, real estate, those are things that are understandable. They're very normal. These are, we're looking to diversify portfolios beyond what would seem as being the more traditional parts of the market. There's a lot of innovation, et cetera. Now, I do find encouraging that people are telling us that they need to, and they have more patience to let their investments grow now than when they first started investing. And the survey covers a wide range of ages. That's intentional. I think that's very interesting. There's, as you parse into it and look at the younger generations, they're getting exposed to investing earlier, newer types of parts of the markets. And as they get exposed to it, contrary to what you might expect, which would be they're all chasing return, they tend to say, you know what, I am learning and realizing that patience is required. So that's what I take from the survey. I do find that encouraging. We'll continue to evolve. We'll continue to innovate. The key is our investors, choosing these wisely, based on their plan, their time horizon, et cetera.
Well, we hope and expect that they are choosing it wisely if they're getting good counsel. And that's what you're finding as well. Rob, great stuff. Thanks for joining me again on the show. I'm sure we'll talk again down the line.
Thanks, Chuck. Always good to talk to you.
That's Rob Williams, Managing Director of Financial Planning at Charles Schwab, which you can learn about online at schwab.com. There's a direct link to their 2025 Modern Wealth Survey on our guest page and in our show notes. And one thing you can plan on for sure, there's more to go on today's show. Stick around. Money Life will be right back.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Did you know that there are at least 23 million American adults who can't read a want-ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
Yes, we can start the story, and the story we are telling today is one about financial fears. Because my guest is Jake Cousineau, and his book is Face Your Financial Fears, the simple guide to fixing your relationship with money. Jake is an educator, and it's written from an educator's perspective. You know that if you listen to the show, that I have this love-hate thing with financial literacy efforts. Because on the one hand, I love them and what they're trying to do. And on the other hand, most of them fail because until you're in the crucible and doing it, well, you're not really learning it. You're hearing about it and you're going, oh, I should do something, but you're not really taking it in and applying financial literacy. What I really liked about this book is that this book tries to address that, because a lot of people don't do that other stuff because they are stopping because they have fears. And this book tries to get them past that and get them really started. If you want to learn more about Jake in the book, htapersonalfinance.com is where you can go to get more information. We've got a couple of copies we'll be giving away in a contest as well. Jake Cousineau, welcome to Money Life.
Chuck, happy to be here. Excited to talk about some finance with you. And I totally agree that ambivalent feeling towards financial literacy. Even as an educator, there's some things we do I really like, but I've also got some notes.
I love the efforts. I love the efforts, but I think your book really does address this problem in a very personal way. Because when I talk to people who don't want to address their financial fears or what have you, or I mean, thankfully, so I got remarried just over 2 years ago now.
Congrats.
And my wife will tell you money, it's a tool to her, but she's never been interested in it and what have you. And so her financial problems have never been that she didn't save enough. She just didn't pay attention to sort of how she was doing it. So she's got a portfolio that's not quite appropriate for a woman of her age because she's never managed it. But it's not that she was fearful. She was always going to just throw it in there and the right things will happen. That's not necessarily about fear, but a lot of people, it's, I don't have enough. I'm afraid of messing it up. And I watch, for example, my stepdaughter, and I'm watching financial fear in action, and it bites her in every direction. It's, I don't want to use up all my credit, but I also don't want to use up all my cash. And you're like, you have terrible credit habits.
Correct.
So is financial fear something that is ingrained in us? In other words, we're kind of born with it, etc. Is it because of the experiences we watch with our parents, or is it just because we don't know enough to know what to be scared of?
That's a great question. I just think it's a perfect storm. I mean, like every variable is pointed and sort of pushes people into being afraid of money. I mean, you could start with just the taboo nature of money. Like people don't like to talk about it. For whatever reason, society said like, this is something you can't speak about, right? This is like personal information. You can't speak about it. That does so much more harm than good, like so much more harm than good. On top of that, like the conditions currently are difficult, right? It's difficult to thrive, to succeed financially. And people are naturally, human beings, they're going to avoid things that they sort of feel embarrassed about, things you feel ashamed of, because it doesn't feel good to think about them, right? So if you're in a position where you do need money advice, you really need guidance, you are probably the least likely to ask for it, right? So you're not going to be the one to raise your hand because you're embarrassed about it. And we also have this with, I think social media is a big contributor here, but there's lots of reasons. This false perception that everybody else is thriving, right? Gosh, everybody knows what they're doing with money except for me. I'm this outcast who's, I should be embarrassed about this. And that couldn't be further from the truth. So all of these conditions have created this storm of one, we're bad with money, and also we are not going to talk about it, right? I don't want to talk about it. I'm embarrassed about it. You mentioned, I'm a full-time teacher. I see this, like the longer I do this, the more I realize like my students and adults financially, like this phenomenon within this context are the same, right? When I'm teaching, I need the students who don't understand to raise their hand. Like those are the kids I need to raise their hands. And it's completely backwards. I'm sure you remember when you are a kid, where I would only raise my hand when I knew the answer. Like, I want to show off like, ooh, I know this. Like, and I'm glad you know the answer, students. Like kids, that's great. But you're not the ones that I need to raise your hand. I need the people who need a little bit more clarification, who need me to revisit something. And every time some kid is brave enough to be like, Mr. Coos, I don't understand this. Like 6 other kids are like, oh, thank God. Because I also need I need you to say it one more time. I need you to review it one more time. And adults are the same way. Like we're all afraid, but nobody wants to raise their hand and be like, I don't know what I'm doing with money.
Does that also push us further down the rabbit hole? There has been research done. We've talked about it on the show recently where, the people who are turning to help are turning for, let me go to AI. And AI doesn't know personal finances, and they certainly don't know your personal finances without inputs. So we see all the time bad answers. Does that make things worse? It's like, okay, wait, I have this fear. I don't want to embarrass myself by talking about it to the neighbors, but oh, by the way, that pushes me to, even if it's not AI, conflicted sources of information, people who are trying to sell me stuff, things along those lines.
Absolutely. I mean, I've got a chapter in my book that's basically a through line through my whole book is you have to make personal finance personal. You have to truly understand your situation. Because when I first started on my financial journey, and I don't have a finance background, I'm not an MBA, I don't have a CFP. I was just a broke dude who made every mistake I could and who really enjoyed reading. So I read every book I could and I sort of figured it out. But in my early days, when I would look things up, and nowadays you're going to go to AI, everything, all the information is, they try to make it generalizable, based on sort of averages. And if you look at averages, nobody fits within those averages, right? Like no human is going to fit all the average debt, the average income, the average housing payment, whatever it is. So if you go online, if you're just looking at general advice, you are you're sort of likely to look at this advice and say, what is this talking about? This does not apply to me. Like there's no way I could achieve this, or that just doesn't make sense. And that's simply because you have to make personal finance personal. You have to look at the information based on your income, based on your expenses. Do you have children? Do you not have children? Do you live in a high cost of living area? Yeah, so I think if you go on to AI, it's more likely to just sort of turn you away from finance, because you're going to get information and say, there's no way that this applies to me, and it's going to leave you with a belief that any efforts I make are, they're futile. It's not going to work out.
The book is really all about developing a good relationship with money. But most people don't look at it as a relationship. Most people look at it as limiting or what have you. Budget is to somebody with money what diet is to somebody who likes to eat. It is, how shall I restrict you and make you uncomfortable and all those other sorts of things. How do you convince people that, living within your means, not necessarily having the latest iPhone or the latest gadget or what have you, getting to where you have solid financial footing first before you do that other stuff? How do you convince them that in a consumer-driven society like the one we've got?
Yeah, I mean, that can be an uphill battle. But I also think, again, because so many people, personal finance is so foreign to them for the majority of people. They're so far removed from what it actually looks like to have a healthy budget or to actually build wealth. So they think of a budget as, strict austerity measures. Like, Chuck, you cannot spend any more on this. You can never go to Starbucks again. You can never go on a vacation. And that's just simply not true. Actually, a good budget will allow you to do those things, but it will actually allow you to do them sort of guilt-free. And I've spent, my 20s, I'd be on vacation or something, but I wouldn't be present because in my mind, I'd be like, I know I can't afford this, right? I feel guilty sort of even being here. But a good budget, once you realize how wealth is actually built, people stress about retirement and they're like, gosh, I have no idea how to invest or something. And an example I often give is, let's say you have a current car payment of $500. So you're 30 years old, you're paying $500 a month for your car, and your payments are just about to end. Your term's about to end. And you're thinking, I have $0 saved for retirement. So you're so stressed, you're like, I'm ruined. Well, if you're used to living, there's two ways to look at it. So Chuck, you could sort of go the way you prefaced a little bit. You could be really excited and be like, oof, I got $500 about to enter my budget, right? As soon as this car is paid off, I've got an extra $500. This is going to be fun money. And you'll probably spend it on something frivolous. But you're also really concerned about your retirement. Now, if you just, do a little bit of research and understand how wealth is built and how retirement through compounding interest, that $500 a month can really go far. If you say, what, I'm already used to not having that $500, I'm just going to direct that immediately to my retirement. That $500 car payment is now going to be my retirement. If you just keep that behavior, you don't change anything. Like it means nothing to you because you're used to that $500 already being spent. Now, all of a sudden, $500 a month at 30, you're looking at, $600,000-$700,000 in retirement. Like your retirement fears may have just been solved by simply paying off that car payment and resisting that urge to spend $500 every single month, right? It takes no lifestyle change on your part. It's your budget looks the same. That $500 is simply being redirected. You got rid of a liability, the car, and now it's going to your retirement. But people don't really look at it that way. Like you could have just solved all of your retirement problems or like really severely mitigated them. But, people don't understand that your retirement could just be a couple $100s per month because they don't understand like just how powerful compound interest is.
How much is the industry working against the individual in your mind? Because you just gave that example. The example I always use in that case is credit card minimums.
Mm-hmm.
Where if your credit card minimum was $100 today and you pay the minimum, you can look at it and go, it'll take you 23 years to pay this off. But if your credit card minimum is $100 today and you pay your $100, the next month it's $99. And the month after that, it's $98. If you could just stick with that $100 payment, you'll make it in 7 years, which is still a long time, but it's a lot better than 23. It's a lot better. How much does the industry contribute to the fear factor?
I think it's huge. Obviously, like if you go to, I mean, each industry is sort of incentivized for you to lose money, really. Right? If you go to a car dealership, they're going to ask you a very misleading question. How low do you want your monthly payments? Just like you were saying, right? The $100, and you go, ooh, $300 a month. But then you find out like, oh, it's an 8-year car loan. Like, what are you talking about? 8 years? Like now they're talking about 7 years, 6 years, whatever it is. I'm still like, pay it off in 5 years or less for sure. But I think that really just speaks to, yeah, the industry is definitely trying to make money off the individual. But that's a great example of like how sort of low the bar is for financial literacy in this country. Like, you need to understand interest rates. Like my first book, the first chapter is on interest rates. I still spend time in my next book, a lot of time dedicated to just a basic understanding of interest rates. Because if you can calculate that, if you realize, like the one thing you have to calculate is your first payment, your monthly payment, how much of your money goes toward interest. Because that is effectively how much money you are throwing into the garbage before you actually begin to pay your loan back, right? If it's $200 in interest that first month and the salesperson says, oh, $225 a month, you need to know you're going to be paying $225 and you're only going to be getting $25 in value, right? Because $200 is going into the trash. At the bare minimum, we need to understand interest rates. And I promise you, if anybody out there is like, ooh, interest rates are kind of confusing, it's really not. You just probably haven't spent too much time studying it at all. I'm willing to bet nobody has tried to teach it to you. So at the bare minimum, we need to understand interest rates because, as you point out, if you don't understand that, it's very easy to turn, a $20,000 car loan into a $45,000, car loan at the end of the day. If you don't understand how much value there is in paying off your loan a little bit more quickly, throwing extra towards the principal. Again, these terms are scary to people. So like if you don't have those basics understood, it's very easy to pay so much more and just sort of be taken advantage of.
Yeah, in the old days, I would have told people to go find my friend Mark Isenson's book, The Banker's Secret. These days, you can find a bunch of those things online, but better yet, you can find a bunch of those things that are going to help you in Jake Cousineau's book, Face Your Financial Fears, The Simple Guide to Fixing Your Relationship with Money. Jake, great stuff. I wish we had more time. Good luck with the book. We'll talk to you again now, hopefully down the line.
Thank you so much. Great to be here.
That's Jake Cousineau. And again, if you want to learn more about Face Your Financial Fears, you can go to his website, htapersonalfinance.com. And we will be giving away copies of the book in a contest, so make sure you listen around for that. And remember, there's more of Money Life to go, so you don't have to fear that we're going anywhere. We'll be back in just a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We're back to wrap this one up. And yeah, it is an unusual show where we have two surveys. And largely things were evergreen. I had promised you something new. This was not entirely what we expected. We are going to be starting a new segment called The Week That Is with VJ Marolia from Regal Point Capital that we're very excited about because we really like what it does. It kind of puts a cap on the week that was and it looks at the week that is coming, etc. That's going to become our first thing on Mondays. And the plan was to debut it today. And then a few things came up around the holidays. And, when you're trying to do something, we want to get it off to a good start and have you guys be happy about what you're hearing and more. And it just took a little bit more time. So that meant we were scrambling a little bit, but not much because we had a couple things that we had done that were waiting to find their spot. So a little bit of an unusual show today, but the rest of December is completely loaded up. And by the way, that starts tomorrow because Indrani Day, head of global investment research for FTSE Russell, will be here. Then Steve Rick, chief economist at TrueStage, will be here on Wednesday. Then Brad Newman, senior vice president, director of market strategy for Alger, will be here on Thursday. And it just starts rolling. But among the highlights this month, Dan Fuss, bond fund legend, will be here on December the 11th. We just added Ed Clissold from Ned Davis Research, but also coming George Borey from Allspring Global, Daniel Morris, chief investment strategist at BNP Paribas, Brent Schutte from Northwestern Mutual, Bob Dahl, who of course is here. He'll review his picks from this year, how they turned out. He'll give us his picks for next year as we get into the new year. Steve Sosnick from Interactive Brokers will be here on Christmas Eve day, and much more. So I know it's the holidays and you got a lot to do, but hopefully you can do it with us. Like, we'll be part of your soundtrack for the month. And that's just big interviews. We have a lot of things coming as well in the market call, including, I will simply tell about the one I'm most excited about right now. Nick Rach, Chief Executive Officer for the Earnings Scout, who has not been on the show for several years, makes his return. And every time he's been on, a whole bunch of you really talk about how you like or love his methodology. And that's also, by the way, we have a full month of technical analysts, Ken Berman from Gorilla Trades, Jeff Bierman from The Quant Guy, Greg Harmon from Dragonfly Capital, and more. But if you are simply looking for something to celebrate, well, there's a lot on the ticket today. By the way, my father, he would have been 101 today. So I tip my cap to him. He's been gone now. Well, he died when he was 87. So he's been gone for a while, but I miss him. But of course, it's Cyber Monday. And I don't know if you want to celebrate that one. From a financial standpoint, of course, Cyber Monday is a day to go spend money. So maybe not. Much more importantly, it's Rosa Parks Day. 70 years ago today, December 1st, 1955, Rosa Parks refused to yield her bus seat to a white passenger. She was arrested. And then there was a bus boycott in Montgomery, Alabama that lasted for over a year. And you know, I think, the rest of that story, and thank goodness for it. But today is also a day without art, which is a day of mourning that recognizes the lives lost to AIDS. And having lost a few friends to AIDS, I will simply point out that it's become something that we sort of forget about or have moved past, et cetera, but we shouldn't. And this is a day when people cover the art, particularly of those who we lost to AIDS. And it is a good reminder. By the way, also in the art community, it's Walt Disney Day. It was his birthday in 1901. And he died in 1966, which always surprises me because in my head, I remember when he died, but I know I must not have because I was only 4. But I guess what I more remember is, you know, what they were doing with the wonderful world of Disney, even though he was no longer there. It's also bifocals at the Monitor Liberation Day. This is an important one for somebody like me because it's about how your eyes change. And my eyes have changed to where I don't wear. If you see me in videos, you typically see me not wearing my glasses. And it's not that I don't have them, because I do. It's that my eyes have changed to basically where I don't need them when I'm sitting at the monitor, which is a plus that a lot of you will not have. But your eyes do change. Please get them checked, et cetera, especially if you're doing anything with headaches or any of the rest, because until you take the time to notice and take off your glasses, you may not really realize how big the change is because you're so used to wearing them. On the food front, it's National Eat a Red Apple Day, and then it's National Pie Day.
Wow! A pie!
And if that pie is fried, then you cross 2 off, because for some reason it's not just National Pie Day, it's National Fried Pie Day as well. My guests today were Sonia Freyer, Head of Cash Management for Vanguard, Vanguard.com. And of course, we're talking about their financial resolution rebound. You can find a direct link to that in our show notes. Jake Cousineau, author of Face Your Financial Fears, The Simple Guide to Fixing Your Relationship with Money, HTAPersonalfinance.com. David Traynor, founder and president at NewConstructs.com. And Rob Williams, Managing Director of Financial Planning at Charles Schwab, which is online at schwab.com, and also a direct link in our show notes. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Peter Lynch, who said, "The old Wall Street adage, never invest in anything that eats or needs repairs, may apply to racehorses, but it's malarkey when it comes to houses." Yeah, you've heard a lot about houses. You've got to find a way to make them the right kind of asset. But to do that, you have to keep everything in perspective. The best way to do that is to remember that until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
This party is over. Everybody out!